Today's episode is sponsored by Trading 212, the platform bringing commission-free investing to everyone. National debt figures are staggering, running to trillions of pounds in the UK and tens of trillions of dollars in the US. Headlines warn of unsustainable paths and ticking time bombs under our economies. But is government debt really out of control?
I want to know how we got buried under this mountain of debt and what the real risks are. And in today's Dumb Question of the Week, we ask, is government debt just like household debt, only much bigger? All right, let's get into it. So this week, Roman, we're going to be talking about things which involve very big numbers, in the trillions. Now, I want to avoid the trap where we go, big number equals scary. So I think what we should do, if we can, is always talk about things as percentages of GDP, if we can.
Yeah, otherwise the numbers just look crazy. You should always scale it in terms of the size of the economy. An economy that's 10 times as big can maintain a level of debt which is 10 times larger.
So let's just get to it straight away then. How big is the public debt in the UK?
So public sector net debt, and that excludes public sector banks, that was estimated at about 95.5% of GDP, gross domestic product, and that was for February 2025. So a little bit under 100% of GDP.
Should we give some context to that? Because it has risen sharply over the past 25 years. If we go back to the turn of the millennium, the year 2000, public debt at that point was 28.3% of GDP, and now we're at nearly 100.
And again, if you zoom out here, I think it's useful and go all the way back to the 1700s.
Right. I thought going back to the millennium was fair enough. We're turning the time machine way back.
But with the UK, you can do that, which is great. But 2000 was very much a low point in debt to GDP for the UK. Just prior to that, well, I say just, about 50 years prior to that, just after World War II, that's when we reached our all-time high for debt to GDP. There it peaked at just over 250% briefly. And after World War I, it peaked at about just under 200%. So clearly, times of crisis, when you really have to raise a lot of taxes, raise a lot of income and spend it, those are the periods in time when government really splurges out and issues lots of debt and pushes up debt to GDP.
You promised me the 1700s. Keep going.
Okay, so another peak was just after the Napoleonic War. Clearly, we had to pay for that. Then we had the American War of Independence. Before that, the 7 Years' War, the War of the Austrian Succession. And each of these had its own little peak, which built up to a crescendo of the Napoleonic Wars, when debt to GDP reached about 200% again. But then if we go further back in time, all the way back to 1700, debt to GDP was tiny. It was only about 25%. And the first thing that really pushed us up the hill was the War of the Spanish Succession.
Seems like there's a lot of wars in British history, if we're looking at the debt to GDP ratio.
But the reason why we won those wars was that we were very good at issuing debt. At least that's one argument.
But we're not fighting a war right now. So how has debt gone from just under 30% of GDP in the year 2000 to almost 100% now?
Well, that's why it hasn't got to 200% probably. But we have had COVID, which is kind of like a war against a virus. So I'd argue that something like a pandemic would also count as something which is going to push up debt to GDP. Any kind of big crisis where you have to spend a lot.
And we did spend a lot through COVID on furlough and on healthcare costs. And of course, before that, we had the global financial crisis, which really cost a lot in terms of bank bailouts and stimulus packages.
And of course, growth, because if you're comparing debt to GDP, if GDP growth is weak and debt growth doesn't subside, debt to GDP is going to go up. And it has to be said, in the past, whenever we've actually reduced our debt to GDP, so this was following the Napoleonic War and following World War II, the way that number's fallen is because GDP growth has been more rapid than debt growth.
Yeah, we've grown our way out of it to some extent and inflated our way out a little bit.
Yeah.
And here I think it's worth being clear about the difference between the national debt and the deficit, because you hear a lot in the media about the deficit, and I guess that is the engine by which the debt grows.
Yeah, so this is the distinction between levels and flows. The deficit is what makes debt grow because you plug the difference between tax income and expenditure by issuing debt. And then the level of debt grows if the deficit is continually large.
And at the moment, the deficit in the UK, which is called public sector net borrowing, is around £137 billion this year, which is 4.8% of GDP, and is too high to be sustainable in the long run, really. Now, the Office for Budget Responsibility issued a report last week alongside the spring statement, which showed that based on the government's spending plans and tax plans and its assumptions around growth and things like that, it expects the deficit to fall to 2.1% of GDP by the end of this parliament in 2030.
So it's fair to say this government takes debt to GDP very seriously. They haven't splurged on spending, and they're very keen on getting debt to GDP under control.
Now, if we turn our attention to the US, obviously the numbers are much bigger there because it's a much bigger country. But they're experiencing a kind of similar thing to the UK, where deficits are very large by historic standards and debt has been rising fast.
So for the United States, it depends how you measure it. But if you look at what the CBO recommends, which is federal debt held by the public as a percentage of GDP, that's just a shade under 100%. It's 97%.
So similar ballpark to the UK, really.
Yeah, it's not very different at all.
Now, you might see a lot of people quote the gross federal debt, which is the broadest measure of debt, and that's much higher. That's around 123% of GDP in the US. But as you say, the CBO thinks that's not the best measure of debt because it includes debt that's held by the government itself, and that is generally through schemes like Social Security and retirement programs and Medicare, where they invest in treasuries themselves. So it's the government kind of owing itself money.
And I think we should probably mention what the CBO is. It's the Congressional Budget Office. Now, this is a non-partisan organization in the United States. It was set up by a congressional act in 1974. And the idea is that it provides objective, non-partisan information to support the congressional budget process.
Yeah, and handily, they issued their latest report last week, much like the OBR in the UK, and they project forward what's going to happen to the US deficit and the US debt over the next 30 years. And crucially, they do that on the basis of what is the law at the moment.
Now, we can talk about this in a sec. I think that's a problematic way of doing it. But whenever you look at their projections, it's always quite alarming.
It sure is. So when I looked at it this time, it said by 2055, federal debt held by the public will reach 156% of GDP and remain on track to increase thereafter. If you look at the graph, it's a scary graph. It's steep, isn't it?
Yeah, it starts at 100 today, and then it just seems to grow in a fairly linear fashion all the way up to 2055.
And as you'd expect, the reason the debt keeps growing throughout the period is because deficits are baked in across the period based on current law. So over the next 30 years, the CBO estimates the deficit to be 6.3% of GDP, which is more than 1.5 times the average over the last 50 years. And that larger deficit is primarily being driven by an increase in interest costs as the US has to service its debt, but also increased spending on healthcare programs like Medicare, Social Security, you've got an aging population, and actually trend growth, which is weaker than it's been over the last 50 years on average.
And again, if you look at that history of fiscal deficit for the United States, currently it's pretty large. It's about 6.3%. But it's been gradually getting larger since 2000. It's just government after government, Republican or Democrat, has been gradually increasing how much the government spends without taxes paying for it, and then plugging the difference with debt. Now, when interest rates were pretty much zero since 2007, that wasn't such a big problem because the debt servicing cost was small. But now that we're starting to see interest rates pick up back to normal, it's a big problem. For example, a lot of people quote the fact that the US is spending more on debt servicing than it is on defence. And that is unusual. If you go back before 1990, the fiscal deficit was much smaller. It's only when you go back to the Second World War that you see a really huge fiscal deficit when it ballooned out beyond 25%.
I found that stat surprising, that the US is spending around $1 trillion a year on interest, give or take, and the defense budget is something like $850 billion. So yeah, it's spending more just servicing its debt than it is on tanks and fighter jets and missile systems and all that stuff which we associate with US federal spending.
But can I just say that one of the side effects of a fiscal deficit is government bonds? And I love government bonds. So, in my world, it's my happy place. Obviously, too much government debt, not such a happy place. So within reason, I think having a deficit's okay. And in fact, it's probably normal and it's probably good. But when it gets out of control, which is the topic of today's podcast, that's the real problem.
Yeah, Roman, you're not a price-insensitive buyer, are you? You have to look at the market and make a judgment call.
I do look at the yields, yeah.
But the thing is, you've got tens of trillions of debt in the US. It can run a surplus for quite a while, and there'll still be plenty of treasuries for you to buy as they roll them over.
That's right. I mean, they've got to issue new stuff because it does mature. But there is a kind of servicing aspect where you just roll over the existing debt, and then there's a question of expanding it.
So obviously you like bonds, but it's fair to say a lot of people like bonds. And they are a mainstay of balance sheets across the world. But who holds all this debt?
So the outstanding debt, US Treasuries, at the moment is about $36 trillion. And 2/3 of that is held by US citizens. Now, that's not really a problem because if you're a US citizen, presumably you don't want to scupper your own government by selling their debt. You don't want to destabilize your own country.
And when you say US citizens, you're including institutions like pension funds and insurers and all of that stuff in there as well.
Exactly. Institutions probably hold more than retail investors. I'm not sure what that split is for the US. But what's perhaps more worrying are the non-US holders of that debt, which makes up 1/3 of the holdings. Now, people have referred to this as the kindness of strangers. And of course, you can't rely on that kindness, particularly if you're not being very kind to them. For example, Japan holds about just over $1 trillion of that debt. China holds $761 billion, UK $740 billion. Luxembourg, weirdly, $410 billion, given it's essentially a tiny country. But of course, that's often financial institutions buying US debt.
Yeah, tracing the debt's never an easy task, is it? Otherwise, it looks like the Cayman Islands is one of the biggest holders of US debt.
Yeah, they hold $404 billion.
Which on a per capita basis is insane.
And Belgium, our favourite country, $378 billion.
Some of that's China, actually, routed through Belgium.
Yeah.
But another big holder of US federal debt is, of course, the Federal Reserve. Its various quantitative easing schemes over the last 20 years have in effect meant buying treasuries and boosting the size of the central bank balance sheet. But here we get to an interesting question of, is that really debt? Or is it a kind of accounting trick on the national balance sheets where you've printed money to buy your own debt?
It is odd, isn't it? And you get into all sorts of circular arguments about whether it's real debt or not, whether it's effectively been retired.
Legally, it hasn't been retired.
Yeah.
And they are winding it down.
Now, quantitative tightening is important because you can see that if you measure the US Treasury securities, the holdings by the Fed for treasuries, that peaked at 5.8 trillion, and that was in roughly the spring of 2022. And it's been falling fairly sharply since. So currently it's about 4.2 trillion. So it's diminishing, but the rate of decrease has recently slowed because the Fed's slowed down its QT program, for treasuries at least.
And a similar thing seems to be playing out in the UK, where in fact the Bank of England is actually selling some of its gilt holdings on the open market, somewhat controversially, and is charging the UK Treasury money every year now because it's selling at a loss. This is all a weird accounting trick, as you say, but it does mean that the government, and I guess the taxpayer by extension, has to find a bit of extra money every year at the moment.
The UK government, yeah. Whereas in the US, they don't actually sell them. They just wait for them to mature and roll off, as they call it.
But if you accept that this is all a bit of a weird fiction in a way, you can look at a measure like public sector net debt, excluding the Bank of England, which is obviously lower than the actual debt. It's more like 90% rather than the 95 point something percent we talked about earlier. But interestingly, the OBR forecasts that by the end of the Parliament, those things will have both converged at around 95% of GDP as the Bank of England ends its term funding scheme and asset purchase facility, which is what you'd expect, right?
Yeah, it's a normalization to the pre-crisis state of affairs. Now, clearly, what you want to avoid as a government is having to spend a huge amount servicing your debt, because that's money that you can't spend on all the other things that a government needs to run the country. So if we look at the UK, for example, the total spending is just under £1.3 trillion a year, of which 105 billion was the debt interest.
Yeah, so about 4.3% of GDP was spent on debt interest in 22-23, which is a post-war high. Now, the OBR expects that to decline a little bit in the coming years, but not hugely. It's going to be around 4%, maybe a little bit lower by the end of the parliament. And I guess crucially, we are spending a lot more on debt interest than we used to. So in the 10 years before the pandemic, the cost of servicing the national debt was around 2% of GDP on average. So, we're more than twice that at the moment.
So until quite recently, the UK issued a lot of inflation-linked debt. Now, the way those work is that they increase their principal value increases, as does their coupon, in line with RPI inflation. And when RPI inflation zoomed up above 10%, that pushed up the principal values of those notes, of that debt. Now, that's not something that reverses. It carries on being expensive until those bonds mature. So that was a real problem for the UK. A lot of historical inflation-linked debt, which is more expensive to service. And relative to other countries, we issued a lot more of this stuff because our life insurers love it. For the rest of the debt, which is nominal, that wasn't an issue. It wasn't about inflation increasing. Really, the problem there is that there's just more debt outstanding, and because yields are higher, as that debt's rolled over, the government's having to pay more to service those bonds. So all in all, a pretty much perfect storm for the UK government.
So the picture overall, I think you could summarise in the UK and to an extent in the US, is that debt has been rising extremely fast since the financial crisis. Deficits are persistent and governments don't seem to be able to close them. And yields have gone up. And markets are a little bit nervous, I guess you could say now. They're looking at this debt pile and saying, is it sustainable? So I guess when we come back from the break, the question will be, is the debt out of control and is it dangerous?
Today's episode is sponsored by Trading 212, the platform bringing commission-free investing to everyone. Trading 212 Stocks and Shares ISA is the cheapest way to invest, with zero commission and the lowest FX fees I could find on the market. Looking to keep things simple? You can easily automate your investing with pies that allow you to rebalance your portfolio at the click of a button. Customers with Invest accounts can also benefit from the Trading 212 card, which has no FX fees, true interbank rates, and offers 0.5% cash back on all transactions up to £20 per month. Many Happy Returns listeners can claim free fractional shares worth up to £100. Just create and verify a Trading 212 Invest or Stocks ISA account, make a minimum deposit of £1, and use the promo code RAMIN, RAMIN, within 10 days of signing up, or use the link in the show notes. When investing, your capital is at risk and you may get back less than invested. Past performance doesn't guarantee future results. Pies and Autoinvest is an execution-only service, not investment advice or portfolio management. Automatic investing refers to executing scheduled deposits. You're responsible for all investment and rebalancing decisions. Free shares can be fractional. 212 cards are issued by Paynetics, which provide all payment services. Trading 212 provides customer support and user interface. Terms and fees apply.
All right, Roman. So we've got this debt pile. It's roughly the size of the economy and growing. How dangerous is it?
I think debt's a little bit like chocolate in the sense that as long as you don't have too much, it's kind of okay. In small quantities, it's absolutely fine and it makes things better. But the problem really comes when it really starts to create a lopsided economy where debt servicing becomes a really big factor. So, for example, if you're spending a lot on debt servicing costs, you're not going to spend it on public services, on infrastructure, and that can be a problem for future growth. And in order to get rid of it, you may have to increase taxes. And of course, nobody likes that. So it's very politically unpopular. And usually you might expect it to lead to the change of government because nobody's going to vote for a government which has hugely hiked up taxes.
And of course, all those things have growth impacts, don't they? So I guess if you've got rising debt, often comes with higher yields, and that increases borrowing costs across the economy, right? Not just for the government. It means businesses are going to be charged more to borrow and invest, which should slow growth, all else being equal. I guess you could say it's also potentially crowding out business investment because the government is on the markets competing for capital with more debt issuance against corporate bonds. So corporate bonds look less attractive.
Yeah, I think all of that's true. And of course, if you've got less margins for companies, lower margins, that means less profit growth, and it's going to be bad for the equity market. So all in all, not a great thing.
And I think one thing which I worry about more with high debt is that we've talked about how debt often jumps up when you have a crisis, a war, a pandemic, a financial crisis, whatever it is. Those things seem to happen fairly regularly. And I often think there's not much you can do about some of those things. So we'll probably get another crisis at some point. Does it give us less room to act in the next crisis?
Yeah, for example, after World War I in the UK, the debt hadn't fully got back to normal. In fact, it was nowhere near back to normal before the next one. And going back even further, we were talking about the 1700s and 1800s. Well, there was just war after war. And after each one, the debt built up and it never really got a chance to fall. So I think you're right. I think that now we've got less capacity for a future crisis, whether it's a pandemic or whether it's another war.
It's interesting, isn't it? Reading through these reports from the OBR in the UK and the CBO in the US, they make all these projections going forward, 30, 40 years. And everything follows a neat, orderly course where the deficits are kind of the same as they are now into the future. And yeah, it makes the debt look really bad. But to me, I was thinking, that's kind of a best case, right? The world seems to throw problems at us, which means that we then have to suddenly spend another 20% of GDP bailing everything out.
But I think we're lucky that we can do that because in the past, whenever we've needed to, we've been able to. And that's why I think it's really important that the UK is a credible borrower. If we were some country which really didn't care about debt to GDP, then when these crises do occur, at least the people who give us the money can be fairly confident that they will get paid back. Whereas if you're Argentina, that's a much harder case to make.
I mean, we've never defaulted on our debt, have we, in the UK?
Well, there was some close shaves and technical ones, but not really, not for a long time.
Don't scare the horses, Romin. We've never defaulted on our debt in the UK.
No, in the Middle Ages, we were serial defaulters. But look, that was a long time ago. But it's good to know that we would have the capacity to increase our debt to GDP to 200%, as we did in previous wars. And that would give us £3 trillion to spend to defend ourselves.
Do we, though? Why did Liz Truss come a cropper so quickly if we've got that capacity? Yeah, seriously, though, is it because we weren't in a crisis?
I think that was the issue, and it was a period of high inflation, and it just seemed economically illiterate what she did.
I guess the thing is, if a crisis comes along, like COVID, and the world's panicking and markets are panicking, markets, I guess, are rushing out of risky assets like stocks and whatever, and piling into perceived safe assets like gilts. So it maybe constrains yields at the time you're trying to borrow a lot more. Whereas if you try and do that outside of a crisis, you don't have that same benefit of flows.
Yeah, when the economy was effectively healing and it was a period of high inflation, and if you issue lots of debt and have unfunded tax cuts at the same time, well, that's just kind of crazy. And the market punishes crazy.
The problem would be if we have a crisis which is UK specific. So there's no global rush into safe assets. It's just, we're trying to issue a lot of debt at the same time as our yields are rising.
Yeah, that wouldn't be so good.
But could we get one of these crises of confidence from the market, the so-called bond vigilantes rising up, just because they feel that the debt is on an unsustainable path?
I think it's unlikely for the UK, and I think it's unlikely for the US as well, unless there are some obviously crazy signals coming from the government, or just signs that the government doesn't care. They don't care about debt to GDP, because they assume that people will just carry on buying their debt, regardless of whatever they do.
I think that's the situation in the US right now. I don't think either party really cares about debt to GDP. But you see talk of slashing federal spending. Elon Musk's Doge has been tasked with going around finding cuts. He doesn't seem to be finding anything significant. At the same time, they're talking about massive tax cuts. So the interesting thing actually is this CBO report is predicated on the basis that the laws stay the same. Now, that's interesting. Like, what does stay the same mean? Because what you've got baked in the US tax system is things that expire. So Trump instituted massive tax cuts in 2017 in his first term, which are due to expire in the next few years. And the CBO projections assume that they will expire and not be renewed. Yet obviously Trump wants to renew them. He doesn't want to raise taxes from where they are now. And he wants to bring in further tax cuts. So the CBO projections, to me, are like downside projections to the debt.
I agree. And I think if the Trump administration does carry on with its extension of those tax cuts and does produce more of them, well, it'll be really interesting to see what the CBO forecast looks like then. Unless, of course, they shut down the CBO, which would be one really neat solution to that problem.
Probably doesn't help you with rising yields, though, if you shut down the statistics. Flying blind is not something investors welcome. But if you think about it, the US is running chunky deficits of 6 or 7% of GDP. If those go higher again because of further tax cuts and all the other problems you've got with an aging population and lower trend growth, surely there comes a point where the market goes, hang on, you can't do this. Like if the deficit got to 10% and above on a consistent basis, the debt just goes exponential.
Yeah, there is a certain point at which you cross the debt Rubicon and essentially things get completely out of control. I think the US is far from that. I think there are enough people who are sensible in Congress who push back on it and probably stop it happening. But look, ultimately, if markets were worried about debt sustainability, seriously worried in the United States, then yeah, yields would spike and there'd be a huge crisis.
I guess that takes us to a question of what are the possible paths from here to deal with the problem, if it is a problem. So I had a think and came up with 5 possible paths, which I want to run by you, Romin. The one you hinted at there, I've called the shock, which is that a market scare forces drastic action to solve the deficit. Like taxes go up and spending gets slashed immediately just because yields are blowing out and markets force government's hand. That's the most extreme of these situations, I say. The second one, which is less dramatic, I've just called the grind upwards. So this is slow growth, high debt is persisting, taxes maybe go up a little bit, spending gets squeezed a little bit, the economy struggles, but it's not catastrophic. And I would call this kind of a Japanification of the economy. We just muddle through.
You kind of see that happening over the last decade in the United States. They have been muddling through, the deficit's been consistently large, and debt to GDP has been gradually rising. So that has been the grind upwards.
And this isn't to say it's consequence-free. Some people would say you're harming future generations, right, by spending beyond your means now as a government. But maybe let's put a pin in that and come back to it. The third possible path I've called austerity returns. So this is where we do get sharp spending cuts. Elon Musk finds whole departments to take out in the US. He slashes Medicare, he slashes Social Security. And the debt is reduced in the medium term, but the government bears quite a lot of political pain. And I guess growth suffers at the same time.
Oh yeah, that wouldn't be without consequences. Political as well. Because remember, all of these changes come with their own pushback from the electorate.
To me, this is an unlikely path because I think the political pain is too great. As much as Republicans might want to cut social spending, I think a lot of their base rely on Social Security and Medicare.
Yeah, if the spending cuts are too sharp, then remember that government spending actually does stimulate the economy. So if it's too severe, that could itself cause problems. And we're already seeing this in red states where, for example, a large proportion of the government spending has been cut in particular areas which are very painful. And that hasn't gone down well locally.
Yeah, there's a political cost. And I also think there's just an economic question of can you actually bring debt under control through austerity measures? If they're too harsh, the effect on growth might be too big. And it's like a self-defeating policy. Anyway, let's move on to the fourth possible path forward, which I've called inflate away. And this is the idea that the government has this huge debt and it thinks, maybe if I let inflation just run a little hot for the next 10 to 20 years, the real value of that debt will fall as a percentage of GDP.
I think the problem with that one is that the government can't really control inflation. They can have certain policies which make inflation higher, But making it a little bit higher and not a lot higher is actually very difficult. Just look at the Fed's problems getting inflation under control. Plus, they'd have to talk to the Fed in order to let that happen.
You can change the mandate, right? You could say, oh, your inflation target is 4% now for the next 10 years.
But just think what that would do to US debt. It would make a massive difference to the valuation of US debt. It would make a change to the way companies are run. It would be a huge shock if you double the inflation target. So I just don't buy that as a credible way of doing it. And if they try to do it secretly, again, I'm not convinced that the government is competent enough to cover that up.
Even if they could pull it off, it's a stealth tax on savers, effectively, isn't it? It's eroding the real value of savings to fund the government via the back door.
And inflation is so politically unpopular. Just look at all of the discourse about egg prices in the United States.
Yeah.
It's incredible, the amount of pushback that's generated. And you just amplify that by a factor of 10 if they suddenly say, oh, we're telling the Fed to double its inflation target.
Have you seen that the Trump administration seems to be going one by one around the European countries asking for extra egg imports? And they keep getting turned down. Denmark's like, no. Norway, no, go away. Belgium says, no, get your own eggs. This is like the kindness of strangers, right? In a microcosm around eggs rather than deficit funding.
And if relations with those countries were good, maybe they could have talked them around. But this is hardly what I describe as a charming government.
No. And I think we've also moved away from a international order based on rules to one where it's all made by deals, effectively. And I don't know what effect that has long term on capital flows. But anyway, that's a whole nother problem. Let's go to the final path forward I've identified, which is an optimistic one that I've called the growth miracle. And here, the idea is the debt comes well under control just because productivity booms in the coming years. And maybe that's because of AI or something else. But the idea is that economic growth is so hot that the debt becomes trivial.
In an ideal world, that's the way you grow your way out of debt, is to have a pickup in GDP. Now, can I just say there is another sixth path, which is a debt default. So if
Right.
you do get the government suddenly saying, look, you know how we owed you, $36 trillion? Well, if you're a foreign country, we're not going to pay you a penny. Now, would that be a problem? Yeah, it would be hugely disruptive for markets. But under this new approach where anything goes, who knows? Maybe there will be some kind of forcing of governments to accept a write-down on US debt, their treasury holdings.
All bets are off in that situation, I reckon. Who knows what's safe and what's not?
Well, it was part of the Mar-a-Lago thing, which is that governments would willingly swap their US treasuries, coupon-paying treasuries with a fixed maturity date, with century bonds, which have zero coupon, which is a default.
Yeah.
Now, that's not taken seriously. It's not going to be policy, but it is something that's being considered.
All right, so let's nail our colours to the mast then. We've got 6 scenarios. You've added one. We've got the shock, the grind upwards, austerity returns, inflate away, the growth miracle, or default doom. What path do you think we're on?
I think the US is on the grind upwards because clearly the government currently doesn't care about deficits. It's unlikely that a Democrat government would either. So I'd say, yeah, that'll probably continue. In the UK, certainly at the moment, it seems as if we've got kind of austerity returns where we've got a government which is really cutting back on spending, certainly the day-to-day spending, and does care about debt to GDP, so they're trying to get the deficit under control as well. But it's not great for growth. What concerns me is that the UK may move to a more populist flavour of government. If you look at reform in the polls, it's certainly shot up. Who knows what they'll do when it comes to managing the debt?
I think you're right about both those things, but that in the next 30 years, we're going to see either the shock or the growth miracle. Eventually, at some point, who knows where it is, debt becomes a problem, and we either get bailed out by AI or we don't.
Well, you're assuming that it will come to some kind of head, but what about Japan? Japan is way out there in terms of debt to GDP. It's at something like 250%. But life goes on in Japan. Economically, they're okay, not incredibly powerful as an economy now as they used to be. The growth hasn't been phenomenal. And that's despite the huge demographic problems, the fact that other countries are taking their export mantle away from them. And it hasn't come to a head.
No, you're right. It hasn't, at least not yet. There are some differences with Japan, though. Like they have a very high domestic savings rate compared to the US and the UK. And I guess you could argue that the Bank of Japan has somewhat monetized its debt. And I think it has a lot less debt held by foreign investors. But you're right. I guess it shows that high debt isn't automatically fatal. But then yields are starting to creep up in Japan. At this point, by design, they want higher interest rates and they want a bit of inflation to return. But let's hope they can keep that manageable, right? You don't want debt to be 250% of GDP at the same time as your yields go from negative to positive to very, very positive.
Yeah, that would be catastrophic for Japan.
I mean, if you were the government now in the UK, say, what could they do? What should they do? It seems to me that there's no easy fixes. There's just trade-offs involved.
Yeah, and as a politician, you're always thinking about whether you'll get re-elected, which makes you avoid doing the difficult things, which is to raise taxes and to reduce spending. And I think that's not going to be something that any government is going to do lightly. I think a lot of what the current government and the previous one were trying to do was good, which is to boost growth, because ultimately that's what reduces debt to GDP. That's the solution. That's the way out of the problem.
It's true. Like everyone's preferred option is to boost growth, but it's hard to achieve, right? And it requires smart investment and long-term policy planning and perhaps short-term pain. It's just hard to get that going, or it seems to have been. So what you end up with is this kind of technocratic managerial style of government where you've got fiscal rules which you're trying to micromanage your way through. Sometimes the tail is wagging the dog and you're looking at the projections from the OBR, which are clouded in uncertainty, and they admit that. And you're tweaking spending cuts and tax rises based on these very uncertain forecasts. And I think the government in the UK probably is quite constrained for manoeuvre here. Taxes as a share of GDP are at a post-war high of more than 35% and are scheduled to rise to almost 38% in the coming years. And that's already 4.5 percentage points higher than the pre-pandemic level, taxes as a share of GDP. And also, as you hinted at earlier, they are making cuts to welfare spending and to departmental spending outside of protected areas. But still, public spending is high. It's forecast to rise to 45% of GDP next year, which is much higher than it's been in recent decades.
It all seems quite gloomy and depressing when you think about debt, because people always focus on, is it serviceable? Is it out of control? And yet I think people should focus more on how it does create this ability to weather these shocks. And of course you have to deal with the aftermath. That's what we're doing right now. But what it meant was that through the pandemic, we could keep people employed. There wasn't such a big negative shock on the economy where there were loads of layoffs. And then when these crises occur, you can deal with it. And like you, I'm kind of optimistic about what the future holds in terms of getting that debt to GDP down again, just as we had after the Second World War. It fell very dramatically. And after the Napoleonic War. What you kind of rely on is there not to be another crisis in quick succession, or a whole spate of crises, in fact.
Yeah, I think that's right. I wouldn't describe the national debt as out of control, which kind of implies there's an imminent crisis coming over the horizon. But at the same time, at the other extreme, you see some people saying, you don't really need to worry about the debt. Government controls the currency, it can print money. Let's just get on with things and run the economy hot. I don't agree with that either. I think the level of debt we have and the deficits we have do create real tangible problems for the economy and the government. And there are constraints here, genuine constraints around inflation, around the resources available to the real economy, around crowding out, and around political capital and what you can actually do to fix these things before people just get sick of it. And I think the OBR acknowledges that the long-term outlook is difficult. So I'll quote from their latest report. It says, the long-term fiscal outlook remains very challenging, with pressures from an aging population, climate change, and rising geopolitical tensions putting the public finances on an increasingly unsustainable path. The baseline projection would require fiscal tightening of 1.5% of GDP per decade over the next 50 years to return debt to pre-pandemic levels. Leaving policy settings unchanged in the long term would see debt rise to over 270% of GDP by the mid-2070s. The strong words, I think, from a official watchdog.
Fiscal tightening of 1.5% of GDP, that is pretty surprising.
We're not going to do that. That's why growth has to bail us out.
Yeah.
I think the thing that gets lost in all of this debate is that people think about the national debt as a kind of accounting number. It's very abstract, but really it's like a reflection of our collective priorities and our willingness to invest now and delay consumption and agree on how we should pay for the society that we want to have. It's a much, much harder problem than like balancing the books. It's always phrased as balancing the books, but that's just like the trivial bit of it.
And it's the sum of the previous crises we've suffered in recent history, which recently hasn't been great. We've had the financial crisis and then a real crisis with the pandemic. What worries me is that if politicians come along offering simple solutions and saying, yep, bread and circuses, let's just spend, people will carry on buying our debt, it doesn't matter, that's what would really cause a problem.
But you're still happy to buy the debt, aren't you?
Oh yeah, I love it. Now, you've heard I'm a fan of buying government debt. Well, a lot of our content in the past has been about buying gilts, and we've got lots of tools available for people who are interested in buying, say, low-coupon gilts, which are very tax efficient. If you want to learn more about that, why not join our community? Just go to pensioncraft.com/membership.
Okay, today's dumb question of the week. Is government debt just like household debt, only much bigger?
No.
It is a very, very frustrating analogy to hear wheeled out over and over again. But then it's really tempting, right? Because you have to try and make it relevant to people's lives. And I'm sure we've fallen into the trap inadvertently before where you say credit card or mortgage or something when you try to talk about sovereign debt.
I wish I could print money. That would be great.
Well, yeah, there's so many differences, isn't there, of how a government structures its borrowing versus a household. Do you want to run through some of the differences for us?
Okay, the obvious one is if you control money, you can tax people in your own money. And in your own money is really important. If they could pay taxes in some other form, eggs, for example, then your currency wouldn't be so important. But because you can force people to pay taxes in your own currency, that immediately creates value for that currency. So that relationship between seigniorage, the ability to issue money, and the power to tax is inextricably linked.
And I guess it's critical that the government has a monopoly on that power to tax.
And they won't give it up without the use of weapons. So
yeah,
that's important to remember.
But it's a huge difference, isn't it? So you and I, we rely on our salaries or our business income or our investment income, whereas the government can, to a large extent, control its own income and has this massively diversified revenue stream. And I guess the point on currency could be expanded even further to say that for a lot of countries, including the US, including the UK, the government owes debt in its own currency.
Yeah, unless you're in the Eurozone, for example, where that kind of breaks down.
Or in an emerging market where they've borrowed in dollars, say.
Yeah, hard currency debt.
I mean, I guess the implication here is that can a government that owes debt in its own currency actually default legally? Like the US or the UK could print pounds or dollars to pay back creditors. Obviously, there's consequences to that, but they can do it.
And this is an argument why countries which can print money are said to have a very low credit risk. Within reason, they can print money to service the debt. So that's always reassuring. You always want to lend to someone who's got their own printing press.
If they print too much, they might be paying you back in very devalued dollars, but still, you're going to get some dollars somehow.
This is it. Within reason, everything would be fine.
They can't go involuntarily bankrupt like a person can, is what we're saying.
Yeah, ultimately, it's always a matter of choice for a government. Do we default on our external debt? And repudiation of debt is not something that a sane government would take lightly, because it'll have generational costs, because yields will spike and stay high for a long period of time. Bond investors wouldn't forget that.
And you say it's a choice. And I think we should remember here that we're talking about developed market economies that are borrowing in their own currency. Like, it's not a choice if Argentina defaults on its dollar bonds. It might genuinely not be able to get its hands on enough dollars to pay people back. And it's a privilege to be able to borrow in your own currency. And you probably don't want to risk that by annoying markets too much. But there are other differences, aren't there, between a household and a government when it comes to borrowing? One of those being around how long we live.
Yeah, for us, it's all a matter of a lifetime, which is at most about 100 years. For a country, it's effectively eternal. So they don't really have to worry about paying things off over the next century.
Yeah, the government never really aims to get to the position where it has no debt, whereas a person probably doesn't want to die with like massive outstanding debts. Or maybe you do. I don't know.
Another difference is that if I decide to take out a loan, it's not going to massively affect the UK or another country. Whereas if the US decides to massively increase its debt, that would have global implications.
Yeah, it's just the scale of everything, isn't it? Me and you borrowing does not impact our neighbour, whereas government borrowing and spending decisions affect the whole economy. Government debt, its level, its structure, its growth rate, that affects everything from interest rates to inflation to investment to the exchange rate. It's not something that acts in isolation like me going and getting a mortgage.
And I think the reasons behind government borrowing are different from reasons for household borrowing. If I borrow, it's because I haven't got enough ready cash. If the government borrows, it could be because they're trying to do something counter-cyclical. If there has been a slowdown in growth, they may be trying to stimulate the economy by borrowing.
I think that's a really good point. The rational course of action is completely different. Opposite, you might say. Like, if I as an individual lose my job, it's sane and proper to cut my spending, right? To cut my cloth accordingly. Whereas if you think about the government, if the economy tanks and lots of people are losing their jobs, what you want the government to do is to boost spending and to stimulate demand. This is what Keynesian economics says, at least. The government is acting counter-cyclically, like you say. It's completely the opposite to an individual.
And as a final point, whenever people talk about having no debt as if that were a good thing, remember that things like treasuries, UK gilts, actually form the lubricant for the entire financial system, which really wouldn't be able to run as it exists now without that very safe debt. So just remember that one of the side effects of having a deficit and having an outstanding debt is a good thing, which is it makes the financial system work.
I mean, it kind of works, doesn't it? Close enough. We're muddling through. Thank you for joining us for Many Happy Returns. Keep sending us your questions, no matter how dumb, at mhr@pensioncraft.com.
And do remember to check out pensioncraft.com for all the information about our membership, courses, and investment coaching options.
Many Happy Returns is a PensionCraft production, co-hosted and executive produced by Romin Nakiza and Michael Pugh. This podcast is for informational and entertainment purposes and is not financial advice. We do not provide recommendations or endorse any decision to buy, sell, or hold any security. We cannot be held responsible for any actions listeners may take, and investors are encouraged to seek independent financial advice.